Welcome to the debate. What if I told you the anonymous teenager posting rocket emojis on social media might actually have a better trading track record than a billion-dollar mutual fund manager?
I mean, it sounds a bit ridiculous.
It does, right? But today, we are dismantling the financial Wild West to answer a central question. Do social media financial influencers, often called finfluencers, offer genuinely skilled, valuable market insights that democratize investing?
Or on the flip side, does the social trading ecosystem predominantly encourage gambling, manipulation, and, well, predatory behavior?
Exactly. And we are connecting the dots across a wealth of raw material to figure this out. We are looking at academic research analyzing millions of data points on platforms like StockTwits and Wikifolio. We have SEC enforcement records.
And we also have institutional manager selection frameworks from Barclays, to serve as a baseline for traditional finance.
Right. So I approach this data convinced that, despite the undeniable noise, a substantial portion of influencers actually possess measurable, mathematically verifiable skill. They offer contrarian insights that generate real alpha.
Yeah, and I look at that exact same ecosystem and see a core architecture where the structural incentives overwhelmingly promote lottery-like gambling. It is an environment almost entirely built on unverified claims and, frankly, severe conflicts of interest.
Well, let's get right into the data, because the numbers here tell a compelling story. Yes, the finfluencer space is incredibly noisy, I won't deny that. But researchers analyzed 72 million tweets on StockTwits.
Wow, 72 million?
Yeah, it's a massive sample size. They cross-referenced them with Bloomberg terminal data, and they mathematically separated the noise from the signal. They found that 28% of these users actually exhibit measurable trading skill.
Wait, 28%? By definition, that means over 70% of the platform has absolutely no idea what they are doing.
Well, yes.
They're just adding to the noise, and often, they are the ones yelling the loudest.
That is a fair critique of the majority, absolutely. But we cannot ignore the minority who are consistently beating the market. Let me explain the mechanism behind what this skilled 28% is actually doing.
Okay, go ahead.
When retail traders become euphoric over a stock, driving the price up purely on hype, the skilled finfluencer recognizes that the valuation has detached from reality.
So they fade that crowd.
Exactly. They will post negative sentiment warnings, and they will take profits or short the stock right before institutional algorithms step in and trigger a reversion to the mean.
Right.
And the performance metrics confirm this works. Positive tweets by these skilled finfluencers yield positive abnormal returns. We're talking roughly 0.1% in a single day, and nearly a full 1% over 5 days. They are capitalizing on the emotional overreactions of the herd.
I just come at it from a completely different direction. The basic architecture of social trading does not reward that kind of genuine skill. It rewards reckless risk-taking. You mentioned the 70% who are unskilled.
Yeah.
We have to look at the regulatory reality of sharing a platform with those actors. The SEC recently brought an enforcement action against 8 major influencers. They were running a $100 million stock manipulation scheme promoted directly on Discord and Twitter.
Well, the existence of bad actors is a reality in any financial system, but
Let me finish this point, because the mechanics of how these platforms operate are vital here. When we examine the social trading research specifically focused on signal providers, like those on the Wikifolio platform, we see exactly how they manipulate followers.
how so?
These providers actively target equities with extreme idiosyncratic volatility and high skewness. To put that in plain English, they are looking for lottery tickets.
Right, the high-risk plays.
Exactly. These are stocks where you will most likely lose money, but there is a tiny, fractional probability of a massive 500% payout. These so-called gurus are not utilizing true market skill, they are selling variance disguised as talent.
I see.
They take massive asymmetrical risks until one of those lottery tickets hits. Then they use that manufactured fame to collect subscription fees from followers and then front-run their own audience.
Well, I think we need to clearly define what skill looks like in the wild, Because researchers can mathematically separate those variant sellers from the skilled actors. It comes down to return chasing.
Ah, the FOMO traders?
Precisely. Unskilled actors exhibit extreme reactions to hot stocks. If a stock is in the highest decile of returns over the prior 5 trading days, meaning it is already up massively, the unskilled traders are the ones posting aggressively about it.
Driven entirely by the fear of missing out.
Exactly. But skilled finfluencers explicitly avoid this. The data shows they wait for the panic or the euphoria, and they trade the reversion.
But the perception of skill on these platforms is almost entirely fabricated. You are relying on data scraped from public posts, but those posts are heavily manipulated by the influencers themselves.
Well, let's compare that to the traditional alternative. Look at the Barclays framework for institutional manager selection. This is the pinnacle of the traditional finance world.
Right.
Even among top quartile mutual fund managers, the absolute best of the best in equities, only a tiny fraction maintain their rank over 3 or 5 years. On average, only 12% of top quartile managers stay there over a 5-year period.
Yeah, that's standard meme reversion.
Exactly. The vast majority revert to the median or underperform the index entirely. So why do we demand absolute perfection and zero noise from retail finfluencers when traditional managers with armies of analysts and Ivy League degrees also struggle with consistency?
I'm sorry, but I just don't buy that comparison. Let me tell you why. When a traditional manager underperforms, they are still operating under strict compliance procedures, risk controls, and audited reporting.
Sure, the oversight is different.
Radically different. You know exactly what they bought, when they bought it, and what the management fee is. Their failures are public record. Retail finfluencers actively manipulate the perception of skill to hide their lack of consistency.
But how are they manipulating the perception if the researchers are tracking millions of real-time posts?
Through techniques like multi-layered callouts, it is incredibly common. A popular social media trader will post a chart with, say, 5 different pivot points or support levels.
Okay.
They might say, go long here, short here, take profit at level A, B, or C. By providing so many targets, the market will inevitably hit one of those lines purely by random walk.
So they cover all their bases.
Exactly. At the end of the day, the influencer simply highlights the one line that worked and claims victory. It is exactly like a psychic predicting 10 different disasters for the coming year.
That's quite the analogy.
But it's true. When an earthquake happens, they scream, "I told you so," and conveniently delete the 9 tweets about alien invasions. Furthermore, they utilize extreme survivorship bias. They simply delete the bad calls. A traditional manager cannot delete a bad quarter from their SEC filings. An influencer can scrub their timeline in 30 seconds.
The psychic analogy is clever, but I see why you think that. But let me give you a different perspective here. The existence of bad actors utilizing multi-layered callouts or deleting tweets does not negate the broader empirical reality found in the data.
How does the data account for the deleted tweets, though?
Because the market mathematically punishes the exact behavior you are describing. According to the research, a 1% increase in a user's return-chasing tendency is associated with a notable drop in performance. The market actively destroys the capital of the pump and dumpers and the variance sellers over time. The genuinely skilled 28% are succeeding over multi-week horizons precisely because they do the exact opposite of the scammers.
But the scammers do not care about their trading capital being destroyed.
Why wouldn't they?
Because their trading capital isn't their primary source of income. This brings us to the core issue, the structural incentives and conflicts of interest. We have to look at the business model of the fake guru.
You're talking about the subscription model.
Exactly. Look at the red flags that retail traders constantly encounter. You have over-the-top lifestyle marketing, sports cars, stacks of cash, private jets.
Yeah, it's very theatrical.
Very. You have a complete lack of verified, audited track records. And most importantly, you have the $39 a month Discord subscription fee. Logic dictates that if an individual actually possessed a secret strategy generating thousands of dollars in alpha every single day, they would be quietly compounding their own capital.
Rather than selling it.
Right. They would not be spending hours a day moderating a chat room and selling access to their strategy for $39 a month. The true incentive of the finfluencer is generating engagement to sell subscriptions.
I am not convinced by that line of reasoning, because you are assuming the monetization model inherently corrupts the trading skill. Let's look at the mechanics of why a skilled trader might want to build a community.
Okay, why would they?
Well, trading is a highly isolating profession.
Many skilled individuals build communities for idea generation and real-time sentiment tracking. And if we look at the dynamic readjustment of portfolios in the academic tests, when researchers followed the signals of skilled finfluencers over a 20-day horizon, the abnormal returns continued to climb,
To what level?
reaching over 3.5% for positive tweets. That requires actual, sustained market intuition. You cannot fake a 20-day upward trajectory just by selling Discord subscriptions.
But that assumes the followers can accurately identify who the skilled 28% are amidst the deafening roar of the 72% who are just gambling. And the platforms themselves actively push the users toward gambling.
The platforms do?
Yes. Let's look closely at the Wikifolio data. A signal provider creates a portfolio, and followers can attach their capital to copy those trades. To get followers, you need to stand out on the leaderboard.
Makes sense.
And to stand out, you need astronomical returns. The data shows that signal providers deliberately construct portfolios using stocks with maximum daily returns over the past month.
But those platforms implement safety rails to prevent catastrophic losses.
They try, sure, but the mechanics of those safety rails actually create perverse incentives. If a signal provider on Wikifolio even leaves the door open to using leveraged products, their portfolio carries a permanent warning label.
Oh, I didn't realize that.
Yeah, the algorithm suppresses them. Because the platform restricts leverage for the safety of the copiers, the signal providers are forced to find volatility elsewhere, so they turn to the underlying stocks themselves, picking the most erratic, skew-heavy microcaps available.
That is actually an unintended consequence. The platform bans leverage to protect the user, which ironically forces the influencer into far riskier, unregulated penny stocks just to generate the volatility they need to get noticed.
Exactly. It is a structural hazard. These platforms operate less like a democratized Wall Street and more like a casino, where the influencer is selling the lottery tickets and the platform is taking a cut of the action.
I see the danger there, definitely. But let's bring this back to the Barclays research on traditional managers, because it highlights exactly why the agile, independent finfluencer has a place.
All right, let's hear it.
One of the greatest destroyers of alpha in the traditional financial world is excessive asset growth. Let's look at the mechanics of capacity constraints. When a mutual fund gets too large, say managing $10 billion, its opportunity set shrinks.
Right.
In small cap stock, they cannot just buy a few shares. They have to deploy hundreds of millions of dollars. The mere act of them buying drives the price of the stock up against themselves. They swamp the market. The Barclays paper notes that independent boutique firms manage this capacity far better than massive conglomerates.
Because the massive conglomerates answer to public shareholders who want asset growth, which conflicts with the fund investors who want pure performance.
Precisely. The institutional model has a built-in conflict of interest regarding scale. Now, apply that to the skilled finfluencer. A skilled retail trader with a modest personal account and a following of a few thousand people has a distinct structural advantage over a $10 billion mutual fund.
Because they don't move the market as much.
Exactly. The finfluencer can enter and exit small cap and mid cap positions rapidly. They can exploit short-term news sentiment anomalies without moving the price against themselves. The agility of the independent finfluencer is a feature, not a bug. They just need their audience to use critical thinking to filter out the noise.
Well, critical thinking is a very heavy burden to place on an unsophisticated retail investor who is being bombarded by psychological manipulation, FOMO tactics, and fake urgency.
Yeah.
This ticker is about to explode. Act now. That is the language of the ecosystem. And even if a finfluencer has an agility advantage over a mutual fund, we cannot ignore the information asymmetry between the influencer and their own followers.
What do you mean?
If you are listening to this and you have ever bought a stock purely because a Discord channel was hyping it up, you have likely been on the wrong end of this exact asymmetry.
You are talking about the followers becoming exit liquidity.
Yes. Consider the mechanics of the SEC enforcement action we discussed earlier. Walk through the timeline of how this actually operates.
A group of individuals amassed hundreds of thousands of followers. In the accumulation phase, the influencers would quietly acquire a massive position in a thinly traded penny stock.
And then they pump it.
Exactly. Then came the promotion phase. They would orchestrate a coordinated campaign across Discord and Twitter, claiming the stock was primed for a breakout. Their followers, trusting the manufactured skill of the influencers, bought in, driving the price up.
Creating artificial demand.
Right. Finally, the dump phase. The influencers secretly sold their shares into the artificial demand they created. It is front-running in its purest form. And the victims are the retail traders trying to democratize their wealth.
I acknowledge the severity of that fraud, and it is entirely predatory. But we must separate illegal market manipulation from the legitimate sharing of financial analysis. The existence of a pump and dump scheme does not invalidate the concept of social sentiment as a highly predictive trading indicator.
But is it predictive for the average retail trader?
Sure, because institutional algorithms literally scrape Twitter and stock twits every millisecond of the trading day. Why? Because there's predictive value in that data. If Wall Street quants are mining retail social media for alpha, it proves the intelligence is there.
Sure.
The democratization aspect means retail traders now have access to the exact same sentiment gauges that the hedge funds do.
But the hedge funds have the computational power and the quantitative models to filter out the noise and identify the 28% who are actually skilled. The average retail trader does not.
That is a fair point.
The average retail trader is far more likely to fall prey to survivorship bias. If you only see the winning trades because the influencer deleted the losing ones, your entire perception of mathematical probability becomes warped. You start sizing your positions far too large, expecting a guaranteed win because the guru said so, and that is exactly how retail accounts get blown up.
Which brings us to the absolute necessity of rigorous personal due diligence. You cannot outsource your risk management to an anonymous avatar on a screen.
No, you really can't.
If an investor approaches social trading with the mindset of gathering diverse, contrarian viewpoints rather than seeking a blind copy trading signal, the value is immense. A skilled finfluencer pointing out a discrepancy between market price and underlying fundamentals during a news panic is providing a real-time service. Traditional analyst reports often lag the market by days or weeks.
True.
The independent creator fills that temporal void.
Real-time information flow has accelerated, definitely. But speed does not equal accuracy. The overarching danger of the current ecosystem is that it packages entertainment and gambling as financial education.
Yeah, it does blur the lines.
When you gamify the trading experience, adding leaderboards, rocket emojis, and wrapping it in the aesthetic of lifestyle marketing, you bypass the logical risk assessment centers of the human brain. These structural incentives will always favor the loudest, most aggressive voices over the quiet, methodical ones.
Well, let me summarize my perspective on what the data shows us today. The empirical evidence undeniably confirms the existence of a highly skilled, contrarian subset of retail influencers. These individuals successfully challenge the traditional financial information monopoly.
That is one way to look at it.
By fading the crowd and identifying anomalies in news and social sentiment, they generate measurable, mathematically verifiable alpha. While the environment requires careful navigation, dismissing the entire space as a scam ignores the profound advantage that independent, agile retail analysts have over lumbering, capacity-constrained traditional funds.
And I maintain that while a minority of skilled individuals may exist, the overarching ecosystem remains structurally hazardous. It is an environment heavily weighted toward unverified claims, conflict of interest monetization, and lottery-like gambling behaviors.
We definitely differ on the net impact.
Right, because the lack of regulatory friction allows bad actors to manipulate perceptions, sell variance as skill, and ultimately exploit the very retail investors they claim to be emancipating.
Well, we can certainly acknowledge an area of convergence here. Navigating the social media financial space requires an immense amount of skepticism.
Absolute skepticism. You must demand audited track records, understand the manipulative mechanics of multi-layered callouts, and recognize that anyone selling a guaranteed strategy for a small monthly fee is likely the one making the guaranteed return at your expense.
Detecting true skill requires looking past the loudest voices chasing hot stocks and instead finding those who demonstrate disciplined, contrarian thinking when the rest of the market is losing its head.
Considering multiple perspectives on this issue is vital. The raw data holds a tremendous amount of nuance for those willing to analyze the underlying mechanics themselves rather than just taking a guru's word for it.
Indeed. It seems the rigid models of traditional finance have their capacity limits, but the chaotic landscape of social trading is incredibly perilous for the unprepared. We are left trying to read the diagnostic instruments of a completely new financial era. Thank you for joining us on the debate. And we leave you with this thought. When you look at your own portfolio, are you following a proven, disciplined process, or are you just holding someone else's lottery ticket?